Hello financial fans, welcome back to another stock analysis. Today we'll be covering Enphase, stock ticker ENPH. Enphase Energy is a technology company that specializes in the design and manufacturing of advanced energy management systems for residential and commercial solar power installations. The company was founded in 2006 and is headquartered in Fremont, California. Enphase's primary product is the microinverter, a device that converts direct current electricity produced by solar panels into alternating current electricity that can be used in homes and businesses. The company's microinverter technology is designed to maximize energy production, simplify installation and maintenance, and improve system reliability and safety. Enphase also offers a range of complementary products and services, including monitoring and management software that allows users to monitor the performance of their solar systems in real time. The company's mission is to make solar power more accessible and affordable for everyone, and to help reduce the dependence on fossil fuels and lower the carbon footprint of homes and businesses around the world. They're currently sitting at a $27.9 billion market cap, and in 2022 they generated a revenue of $2.3 billion. 32% of their revenue comes from residential solar, 32% from off-grid solar and storage, 24% from residential storage, and 12% from small commercial storage. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health and the growth of the company, and we'll be using a standard margin of safety of 20%, which can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up, going from $105 million in 2019 to $450 million in 2022. The average EBIT growth was a massive 66%, which is of course because we're using not that much data, but it's still a 10% deduction from a margin of safety. The margin has also gone up, going from 16.8% in 2019 to 19.4% in 2022. The average margin growth was 10.3%, meaning a 5% deduction from a margin of safety. And the final metrics that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see on the graph, their cash position is currently larger than their debt, meaning they can pay off all of their debts by simply using their cash. This is a 0% debt to EBITDA ratio, because Enphase doesn't have any net debt, which is a 5% deduction from margin of safety. The return on invested capital for Enphase is sitting at a whopping 42.9%, meaning a 5% deduction from a margin of safety. Looking very good so far for Enphase. Let's go look at the valuation models next to determine the intrinsic value of Enphase. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Enphase going from 2019 to 2022. The average growth rate in free cash flow during this period annually was 81.21%, and I'm projecting an expected growth rate of 20% annually in their free cash flow over the next 10 years. With this percentage, we can determine the future free cash flow for Enphase and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of $36.6 billion, and to get our equity value, we have to add the cash and equivalents and subtract our debt, leaving us with an equity value of $36.9 billion. All we have to do then is to divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $277.57, which is a 35.41% upside from the current price. The second model that we'll be using is Graham's revised valuation formula. In this model, we look at the earnings per share that Enphase is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a company with no growth has always a PE of 7. Looking at all of these metrics, we get a fair value of this model of $122.67, which is a 40% downside out of this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to Enphase, look at their stock price and the earnings per share to determine the average PE multiple in the industry, which in this case is 104.98. All I have to do then is to multiply by the earnings per share that Enphase is generating, which is $2.61 a share, leaving us with a fair value of $274. This is a 33.67% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that the company will always trade above or below its mean, and the metrics that we in this case use to determine this is the PE ratio. The average PE ratio of the past 4 years was 98.70, and the current PE ratio is 78.54, meaning that it's currently trading under its mean PE. In this case, we get a fair value of $257.60, which is a 25.67% upside out of this model. If you want access to all of these models I use in my valuation, you can head over to my Patreon in the description. Anyways, getting that out of the way, let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, leaving us with an average of $232.96. We've determined a margin of safety earlier by using a standard margin of safety of 20%, deducting it by 5% for the debt to EBITDA, 10% for the EBIT growth, 5% for the margin growth, and another 5% for the return on invested capital, leaving us with no margin of safety at all. Then we still have the fair value of $232.96, and with the current price of $204.99, we get an upside of 13.64%. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.